It was May 6, 2010. For most of the day, it was business as usual on Wall Street. Markets were already on edge, unsettled by a growing debt crisis in Greece, but nothing suggested the abyss that was about to open. Then, at 2:32 in the afternoon, in the blink of an eye, the unimaginable happened. The stock market, the very heart of the global economy, simply broke. In just a few chaotic minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, its biggest intraday point drop in history. The market lost almost $1 trillion in value, a financial black hole that opened and closed so fast, human traders on the floor could only watch in stunned, helpless silence. Their screens flashed red, a blur of numbers that defied all logic and reason. This wasn't a bank failure or a political scandal or a global recession. This was the work of algorithms. Rogue AI, if you will, unleashed by a chain reaction of logic and code that spun completely out of human control. This is the true story of the 2010 flash crash, a real-life cautionary tale that felt straight out of a Black Mirror episode. Today, GENSHIFT is performing an autopsy on this event. We'll show you what happened, how it happened, and why it's a terrifying glimpse into the future of a world increasingly run by AI. One, the system. The rise of high-frequency trading. To understand how a machine could break the market, you first have to understand the machine itself. Before 2010, the financial world had undergone a quiet, seismic revolution. The bustling trading floors you see in old movies, filled with shouting traders waving paper tickets, had been largely replaced by silent, cold data centers. The new king of this domain was high-frequency trading, or HFT. HFT is a form of algorithmic trading that uses immensely powerful computers to execute thousands, sometimes millions of trades in fractions of a second. We're talking about speeds measured in microseconds, 1/millionth of a second. That's faster than the time it takes for the light from your screen to reach your eye, and certainly faster than a human brain can process a single thought. Think of the stock market as a vast digital ocean. HFT algorithms are like a new species of robot shark swimming in these waters. They aren't hunting for big whales. Their entire existence is dedicated to one thing: detecting and devouring millions of tiny, fleeting price differences that are completely invisible to the human eye. If a stock is priced a fraction of a penny cheaper on one exchange than another for just a microsecond, an HFT algorithm will execute a trade to capture that microscopic profit. Do that millions of times a day, and those fractions of a penny add up to billions of dollars. Wall Street became addicted to these robot sharks for one simple reason: liquidity. By constantly placing buy and sell orders, HFT firms flood the market with activity, making it easier for anyone, from a large pension fund to a retail investor, to buy or sell a stock instantly. This constant activity narrows the bid-ask spread, the tiny gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. In theory, this makes the market more efficient and cheaper for everyone. But this efficiency came at a terrible, hidden cost. The market had made a Faustian bargain. In exchange for this speed and liquidity, it had outsourced a massive portion of its activity to algorithms that have no conscience, no common sense, and no loyalty. The liquidity they provided was an illusion, a ghost in the machine. It was there 1 microsecond and could vanish the next, because unlike human market makers of the past, HFT firms have no obligation to stay and stabilize the market when things get rough. Their programming often commands them to do the exact opposite: run at the first sign of trouble. The system was optimized for speed under normal conditions, but this very optimization created a terrifying vulnerability. The robot sharks were invited in to make the ecosystem more efficient, but no one had fully prepared for what would happen if they all went into a synchronized, bloodthirsty frenzy. 2. The trigger, a perfect storm of events. The stage for the disaster was set long before the first algorithm went rogue. May 6, 2010 was already a day of high anxiety. Global markets were tense, spooked by a sovereign debt crisis unfolding in Greece. This fear created a crucial precondition for the crash. Liquidity, the lifeblood of the market, was already starting to dry up as human traders grew cautious and pulled back. The digital ocean was becoming unusually shallow, making any large splash far more disruptive. At 2:32 p.m., that splash arrived, a large, traditional mutual fund firm, Waddell & Reed, initiated a sell order for 75,000 E-mini S&P 500 futures contracts, valued at roughly $4.1 billion. While large, this order wasn't unprecedented. The catastrophe wasn't in the what, but in the how. Waddell & Reed used an automated execution algorithm to sell these contracts. The algorithm was given a simple, blunt instruction: sell the contracts by targeting 9% of the total trading volume in the market at any given moment. But it was given a critical, fatal omission. It had no instructions regarding price or time. It was programmed to chase volume, no matter how low the price fell. The single massive sell order hit the already fragile market like a boulder. The initial buyers were, of course, the HFT algorithms. But these robot sharks aren't long-term investors. They are designed to hold positions for mere microseconds before offloading them. They immediately tried to sell the contracts they had just bought, but with few natural buyers, they began selling them to the only players fast enough to keep up: each other. This triggered what the official SEC and CFTC report later called a frantic game of hot potato. One HFT algorithm would sell to another, which would sell to another, each transaction pushing the price down a tiny fraction more, all within milliseconds. This is where we see the birth of a terrifying new phenomenon: a digital herd mentality. Human herd behavior is driven by fear and social panic. This was different. It was a herd driven by pure, cold, interconnected logic. Each algorithm, seeing the flood of sell orders from its peers, followed its rigid, pre-programmed rules. If price drops and risk increases, sell. They created a massive information cascade, where the signal, sell, was amplified exponentially with every microsecond that passed, completely disconnected from any real-world financial reason. This ignited a catastrophic feedback loop. The HFT's game of hot potato was generating insane levels of trading volume. The Waddell & Reed algorithm, blind to the panic, saw only this spike in volume. It interpreted the frenzy not as a fire alarm, but as a sign of a deep, liquid market ready to absorb its sales. And so, following its prime directive, it accelerated its selling to maintain its 9% volume target. It was pouring gasoline on the very fire it had started. On the trading floors, humans were rendered obsolete. In later interviews, traders described the sheer panic and confusion. They didn't know if the price data was real or if their systems were glitching. As one regulator noted, they decided it was more prudent to stop trading altogether than to risk participating in something so extreme and incomprehensible. At that moment, the machines were in complete control, and they were driving the global financial system off a cliff. 3. The fallout, the damage, and the rescue. What followed was a total breakdown of reality in the world's most advanced financial market. In about 4 minutes, the cascade of algorithmic selling sent prices into a dimension of pure absurdity. The official report found that over 20,000 trades were executed at prices more than 60% away from their values just moments earlier. The most stunning example was Accenture, a massive, stable global consulting firm. Its stock price plummeted from over $40 a share to, for a few surreal seconds, just a single penny. The stock of consumer goods giant Procter & Gamble fell by 37%. These weren't prices based on value. They were digital phantoms created by a system in catastrophic failure. The market had lost its ability to perform its most basic function: price discovery. In total, nearly $1 trillion in market value had been temporarily vaporized. Then, at 2:45 p.m. and 28 seconds, an electronic angel intervened. The Chicago Mercantile Exchange, where the E-mini contracts were traded, had a built-in, automated safety mechanism called the stop logic functionality. When the price fell too far, too fast, it triggered. And what was this complex, heroic intervention that saved the global economy? A 5-second pause. For 5 seconds, trading in the E-mini contracts was halted. That was all it took. That tiny, enforced moment of silence was enough to break the algorithmic feedback loop. The game of hot potato stopped. The digital herd was frozen mid-stampede. It was the system's emergency brake, and it proved that the most powerful solution to a crisis caused by hyperspeed technology was the simple, ancient concept of just stopping. When trading resumed, the spell was broken. Prices began to stabilize and rebound almost as quickly as they had fallen. But the mess was far from over. Humans now had to step in to clean up after the machines. Regulators and exchange officials spent hours manually reviewing the chaos, eventually canceling thousands of the most clearly erroneous trades that had occurred between 2:40 and 3:00 p.m. The flash crash was a brutal, humiliating wake-up call. It exposed fundamental structural weaknesses in the modern market, proving that the system was dangerously fragile. The event spurred a wave of new regulations designed to act as permanent guardrails. The most important of these were market-wide circuit breakers. Now, if the entire market, as measured by the S&P 500 index, drops by a certain percentage, 7% for a level 1 trigger, all trading halts for a 15-minute cooling-off period. To prevent another Accenture-style absurdity, the limit-up, limit-down rule was introduced, which creates a price band for every individual stock, preventing it from being traded at irrational prices. Finally, regulators banned stub quotes, the practice of placing placeholder bids at a penny or offers at $100,000, which contributed to the liquidity vacuum. The algorithms had persuaded each other that a sell-off was happening, despite no fundamental reason. The legacy of the crash was the realization that in a world of automated persuasion, you need automated circuit breakers to enforce a moment of truth. 4. A cautionary tale: the robot in the room. It is tempting to view the flash crash as a freak accident, a one-in-a-million technical glitch. But that would be a dangerously naive conclusion. The flash crash was not an anomaly. It was a prophecy. It was an unambiguous warning about the profound risks of handing over control of our most critical and complex systems to autonomous agents. It was, arguably, the world's first AI-driven financial crisis. A stark reminder that technology can and will fail in ways we cannot predict. The event forces us to confront deep, uncomfortable questions about power and responsibility in an automated world. When a cascade of algorithms causes a trillion-dollar crash, who is to blame? Is it the programmer who wrote the code, the firm that deployed it, the exchange that created the environment for it to run wild? The truth is, our legal and ethical frameworks are struggling to keep up with the technology we've created. This ambiguity, this lack of clear accountability, is a core source of the anxiety many of us feel about the future. This story should feel deeply familiar to Gen Z. You are a generation defined by financial precarity and a deep-seated anxiety about the future of work in an age of AI. The flash crash is a real-world, historical validation of your fears. It's a case study of a system becoming too fast, too complex, and too interconnected for humans to control, with immediate and devastating financial consequences. The danger wasn't a single, super-intelligent rogue AI like in the movies. The danger was a system of relatively dumb AIs, each following its simple logic, whose uncoordinated interactions produced a collective, emergent, and catastrophic failure. This is a far more subtle and far more likely threat than a sci-fi apocalypse. This leaves us with the central dilemma of our time. How do we balance the incredible efficiency and power of AI and automation with the catastrophic potential of its failures? Do we chase speed and productivity at all costs? Or do we consciously build in safeguards, like circuit breakers, that might slow down progress but ensure stability and human control? The lesson of the flash crash is that being a passive victim of technology is a choice. By understanding these events, by performing this autopsy, we move from a place of fear to a place of empowerment. Understanding the risks is the only way we can begin to manage them, and to demand a future where technology serves us, not the other way around. Conclusion. The 2010 flash crash is more than a historical footnote. It is a permanent reminder that our most powerful tools, the ones we build to bring efficiency and order, can fail with a speed and scale that is almost unimaginable. It proved that in our race to build faster and smarter systems, we almost forgot the importance of the off switch. In a world increasingly run by algorithms, our greatest power isn't trying to outthink or outpace the machine. It is the wisdom to understand it, to question it, and to build the guardrails that keep it aligned with human values. Understanding is our best defense. What guardrails do you think we need for AI as it becomes more powerful in finance and in our daily lives? Let us know your thoughts in the comments below. If you found this autopsy valuable, share it with someone who needs to see it, and make sure you subscribe to GenShift for more deep dives that decode the technologies shaping our world.